Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. We're recording this interview on Thursday, June 26, 2025. The 10-year US Treasury yield is down quite a bit in the last 10 days. It's dropped down to 4.25%. I think it was at 4.5% only about 10 days ago. The 30-year US Treasury yield is still holding substantially. It's almost at 5%, at 4.8%. Today's special guest is one of the top macro experts. She released a book a couple years ago, actually almost 2 years ago, August 2023, according to Amazon, Broken Money, Why Our Financial System is Failing Us and How We Can Make It Better. Lyn Alden, thank you for joining me again.
Thanks for having me. Happy to be here.
So, Lyn, I want to ask you about something that you've been talking about for years. You were ahead of the curve on this. You're talking about yield curve control, debt monetization by the US Treasury and the Federal Reserve Bank, basically trying to drive down yields similar to the 1940s and the 1970s. Are we starting to see this now with the US Treasury Secretary Scott Bessent? Because didn't he warn us that he was going to do this when he took over? He was doing like long podcasts and stuff like that. And now the yields are starting to come down.
So I think we've seen kind of dabbling in what we can call financial repression. Yield curve control is a type of financial repression. That's generally a more explicit type, whereas this is like a softer version of it. So it's not, for example, quite the same as what Bank of Japan was doing or what the Fed did back in the 40s. But it is directionally being done for somewhat similar reasons. Bessent's an interesting case because, if you back up a little bit, the Fed has been rather hawkish. Um, And so they've not been the ones doing any sort of kind of yield suppression. They've been, they raised interest rates pretty high. They've been, reducing their overall balance sheet. And so those treasuries and mortgage-backed securities have to go somewhere. And what we saw back in 2022, shortly after the Fed's like really hawkish moves, that was back when the UK gilt market blew up. And also at the same time, the US Treasury market was quite wobbly. We had very high move index, so very high Treasury volatility, kind of a breakout in yields. It was just kind of a vulnerable time for the Treasury market. And then, starting around that time, and especially in 2023, we started to see the Treasury Department step in with actions that I think could be strongly argued to reduce yields. There was that one paper by Rubini and I believe it was Myron, but they published it called Activist Treasury Issuance. Um, and basically, the Treasury Department started shortening its duration of bond issuance, or more specifically, they started issuing excess T-bills. And this was at a time where there's plenty of cash in the reverse repo facility, and that cash is happy to buy T-bills if there are enough available. So they basically, even though there was no recession, there was no kind of spike emergency need for spending in 2022, 2023. It was more of, just kind of after the fact. They issued excess T-bills, which is kind of atypical. And Scott Bessent, bringing this back to the present, he vowed to go back to normal policy, which would be basically to extend the duration while lowering yields. And he had multiple, he wasn't talking about financial repression. He was talking about other methods that he would do to either directly or indirectly get yields down. So his view was if oil's flowing, if other things are going well, then inflation can go down, and he expected that that would get yields down. Um, the way it's turning out so far is that he has not undone Janet Yellen's policy. He's sticking with that current policy for now, which is basically excess T-bill issuance. Um, we'll see what happens after the debt ceiling is resolved. But basically, he's kind of sticking to this excess T-bill issuance policy. The debt ceiling itself is also just, keeping a limit on how much treasuries coming to market because they can't legally issue net new treasuries. They can only replace old ones. And so they're drawing down their cash balance, which ironically tends to be good for liquidity while it happens. And so at the current time, there are some activities that are around the margins, maybe suppressing yields. But I wouldn't say we're in full-blown yield curve control or anything like that. It's just they're still kind of taking unusual actions to some extent, and they've so far been unwilling to maybe issue as much as they normally would on the longer end of the curve.
Okay, so if we're going to start to see full-blown yield curve control or financial repression, we would start to see the Fed's balance sheet. It would do a 180 then, and the Fed's balance sheet would net increase then, and we'd start to see signs what that the money supply was growing.
Yeah, basically the mechanism for yield curve control is that they basically have to open like an unlimited bid at a certain yield level. So if they say we don't want yields to go over 4.5%, they have to, be able to buy every bond that tries to go over 4.5%. Or, basically their price falls below a certain threshold is the other way to put that. Um, and they did that in the 1940s. Japan did that more recently, like in the modern time. I don't think that's going to happen under Jerome Powell. It would take something absolutely catastrophic to financial markets to have him do it. Under him, though, the Fed did openly talk about doing it back at the heart of the sell-off in 2020. So when Treasury markets briefly kind of broke in March and April, the Fed stepped in with significant QE, emergency QE at the time to reliquefy the Treasury market. And they discussed in their meeting minutes, and this is all recorded, doing yield curve control. They never actually ended up doing it. They suppressed yields, but they didn't outright do yield curve control. So I don't have it on my near-term bingo card. But it is kind of it's kind of a last, almost like a nuclear option. That's kind of a fallback option that they can do if other methods to keep the yields reasonable don't work. I think they would resort to cutting yields before they would go that route. They might try normal QE before they go that route. That would be a very strong signal to the market that would have very wide implications, you can say.
I think in the past, yield curve control and financial repression used to be called debt monetization, where the central bank would create new currency out of thin air and buy the bonds. But they have more games. The way the current banking system is set up with fractional reserve banking, they can change the accounting laws. And you've been talking about this, what with the SLR. I'm trying to summarize it in more layman's terms so the average listener who doesn't have a financial background like you and me can understand this. But weren't they talking about changing the accounting laws for the banks so they can force the large banks like primary dealers like a JP Morgan to go and buy more US Treasuries and stuff the Treasuries into there?
Yeah, there's a couple of different layers to that. So if you look again back in the 1940s, and the reason that's a really good time period to be familiar with is because that was the only other time in U.S. history where public debt to GDP was as high as it is now. And in addition to the Fed massively increasing their holdings of treasuries at the time, so debt monetization, they also stuffed as many treasuries as they could in the commercial banking system. An absolutely enormous amount of treasuries were just stuffed into commercial banks. And so we could see something like that in the future as this debt is increasingly still an issue, especially with foreigners not exactly having a very strong appetite for it, especially the foreign official sector. There's still some foreign private sector interest. But basically, banks, because they have fractional reserve levered balance sheets, they have quite a significant ability to absorb treasury issuance. One of the current limitations, kind of on maybe not at the moment because most of them are not SLR constrained, but they were, for example, back in 2021, SLR constrained. Basically, banks they don't have reserve requirements right now, but they have like capital requirements. And reserves are one of the things that they can use to meet their capital requirements. And in practice, they do have a pretty significant amount of reserves currently. But basically, some of those capital requirements are risk weighted, meaning that, for example, a treasury is treated a lot more favorably when determining whether or not the bank's meeting their capital requirement than, say, a loan, for a risky business. So there's like, a different end of the spectrum there.
Well, they're
Uh,
considered pristine collateral, right? So the U.S. Treasuries normally are considered, at least in the current system for a few decades now, they were considered pristine collateral for the banks to go and loan into what derivatives market, make derivatives bets, or repo market, or other things.
and in this context, also for meeting their capital requirements, risk weighted. Now, what the SLR does, the supplementary leverage ratio, but the name's not really important. Basically, it's an extra check on large banks saying that, even like their non-risk weighted capital has to meet a certain threshold. And so that applies to things like treasuries, even though they're, ostensibly risk-free. Um, and what that basically means is that if banks are going to have, pretty big amount of assets, even if they're on paper pretty safe assets, they have to have a lot of capital backing that up. And so by reducing the SLR requirements, It allows banks to potentially hold more treasuries with the same amount of capital. The other possibility is that they could hold kind of the same amount of treasuries, but they could reduce their capital. For example, they could turn to more buybacks and dividends to send some of their capital back to shareholders rather than retain it to buy more treasuries. So I think that SLR exemptions or reductions on their own are unlikely to be very successful in getting banks to hold more treasuries. That would have to be combined with some sort of behind the scenes pressure, which various administrations in other contexts have not really had trouble doing. I mean, banks were for a long time and arguably still are pressured not to really do much business with crypto companies, for example. There are many other kind of like unfavorable quote unquote industries that pressured behind the
Or
scenes
political. I
too.
mean, they debanked Melania Trump too, and a lot of Trump supporters.
So that kind of thing can happen. And I mean, it happened to even things that are not illegal per se, that are just kind of sometimes in the gray market or sometimes legal but just considered unfavorable. Um, they're pressured to not have them as customers. This happens in the U.S. and elsewhere. And one of the things they can do behind the back is say, hey, if you're not buying treasuries, we're going to give you more of a hard time. Um, and
Especially with FACTA, right? The foreign account ones for the foreign banks, they put that in what, 10 years ago. I want to ask you though about the comments that Jamie Dimon has made. I mean, he's warning against trying to force the banks, changing the accounting laws, changing SLR, the leverage ratio, the reserve requirement ratio, and trying to stuff more charges in the banks. Why do you think he's warning to not do that when he's a primary dealer? And you said that basically the treasuries are good collateral for a lot of the banks to do loans and trades.
Well, because even though treasuries are, unless there's a debt ceiling issue or something, unless then Congress kind of chooses to default, they're ostensibly risk free. But even without default risk, there's still risk to holding them, which we saw back in March 2023. Banks literally went under despite holding very safe assets because when interest rates go up, if you have longer duration assets like longer duration treasuries, they can be underwater. And if your depositors pull out, you can't necessarily meet all of your deposit requests, and therefore your bank can get shut down over a weekend. And so,
Even
while
a too big to fail bank, like one of the five or six largest ones, like JP Morgan or Bank of America, you think even those guys would have risk like that? Because I thought they're not even charging depositors like I don't know what the newest percentage is, but I thought like JP Morgan, some of the other money center banks, they were charging like depositors almost nothing to put your money there.
yeah, so they would be extremely hard, not impossible, but extremely hard to do a bank run on. Because I mean, JP Morgan, last I checked, is something like 10% of deposits in the system. So basically, if you imagine like the whole banking deposit is like the whole deposit base is like a swimming pool. One bank, like Silicon Valley Bank, is like a bucket. So if money wants to get out, it can quickly get out and go somewhere else. But if you're like 10% of the pool, um, there's it's not really able to get out quickly to other places. Large business accounts have trouble kind of setting up new bank accounts. This is not really how it works. And so the really big money center banks are pretty resilient to these types of bank runs. Generally speaking, the types of banks that are vulnerable are ones where their duration risk was so large that they risk having negative capital because of it. Uh, and two, they have a higher than normal ratio of uninsured deposits. So basically, deposits above the FDIC limit. Because there were plenty of entities where they actually kind of had issues with the duration, like Charles Schwab, and yet they didn't really face any bank run because there was not a higher than normal threshold of accounts above the FDIC limit. They feel pretty safe because they say even if there's somehow an issue, I would be made whole. On the other hand, there were banks like, say, Citibank, where there is a higher than normal ratio of banks that are above the FDIC limit, but they didn't have that major capital issue. So again, and they're very large. So there was less of pressure there. So the risk to banks in that context is mostly small to medium banks that have big duration losses. Yeah, it's something to monitor.
and
Basically,
not too big to fail, not systemically important. So they're not going to get the accounting laws changed for the large banks, or they're not going to get a covert bailout. So like they let Silicon Valley Bank and some of the other smaller regional banks fail, the medium sized or regional, what they were still top 10 or top 20, but not like one of the five or six too big to fail ones.
yeah, yeah, pretty much. And so basically, the short end of the story is that longer duration treasuries still have risk, especially when you're levered, which banks are.
Do you think it's fair to say that a lot of foreign governments, foreign central banks, maybe outside the G7, are they de-dollarizing if they're maybe going away with their reserve assets from treasuries and buying gold and euros?
Um, so de-dollarizing has multiple kind of different points. So we can kind of break their US dollar reserve currency status into a handful of different parts. One is using it as a reserve asset. Two is using it as on one side of most financial currency exchanges. So the dollar's on 90% of currency exchange, meaning that, for example, if you want to take Korean currency and trade it for Egyptian currency, it's unlikely that those two countries, as random example, are going to have a very liquid market between their currencies, whereas they both are very liquid with the dollar. And so if you want to get from one to the other, you trade one for the dollar and you trade the dollar for the other one. And then it's a cross-border funding currency. And so, if an entity in the UK wants to lend money to an entity in Brazil, in many cases it'll be done in dollars, which is neither of their currency, just because it's the global reserve currency. And then lastly, it's a unit of account for international contracts in many cases, especially energy, but a lot of different types of kind of cross-border contracts. The unit of pricing that they've agreed on is in dollars. So it has those kind of four attributes. We have seen, and this is common in strong dollar environments, which we're still in despite the recently weakened dollar. Um, Basically, foreign official reserves are not growing, especially the dollar portion. They have, especially since the 2022 invasion from Russia to Ukraine and the subsequent freezing of their reserves, there has been a pretty sharp uptick in gold interest, gold buying of central banks. So there is basically evidence that, especially for a foreign official holdings, which is basically the central banks, they're not really buying treasuries that much. They are increasingly shifting a little bit toward gold. The part where I would say de-dollarization is not happening quickly is in the financial lending markets. So there still is a lot of dollar debt outstanding cross-border. Um, there's still a lot of international pricing happening in dollars. And so the overall network effect is still very strong, even though it's I would say it's over its zenith. It's no longer increasing. It's just very, very slowly deteriorating.
Yeah, I don't think it's fair to say that there's rapid de-dollarization. I think it's more about reserve assets change because you're just seeing that the non-G7 central banks have just decided they're not going to be increasing reserve assets for the euro. They don't like the policies there. And then also with all the budget deficits, the interest payments on the debt, they're just looking at the bad policies out of DC, both political parties, the budget deficits, the interest payments on the debt, Congress fighting like crazy for this new tax cut bill, which is not really going to be much of a tax cut at all, given how much pork's going to be stuffed into there, all the extra spending. And they're just saying, you know what, we don't like this here. We're diversifying away from treasuries. That's what looks like the policy. And we've seen this, Lyn, in recent interviews with the World Gold Council. They've been interviewing central bankers from outside the G7, central bankers from Poland and other countries. Sounds like they're reading Austrian School economics and they're diversifying away from dollars and euros. US Treasuries and euros.
Yeah, I mean, if you're running the sovereign reserves of a country, in many cases you're not really sovereign if you have the majority of your assets freezable by another country, and so any issued security is freezable, and so the things that are not freezable are like gold in your own custody, for example. Um, you can also diversify. So you can say, well, they're all freezable, but at least they're not all freezable by the same government. So instead of having, say, 80% of our assets in treasuries, maybe we should reduce it to 50% and spread that other 30% out to others. And so around the margins, there's been a tiny uptick in Chinese currency being used as a reserve asset. There's a tiny uptick in others. But gold's kind of taking the recent lion's share, and the dollar share is kind of flat to down, um, just because there's yeah, like you pointed, there's deficit issues, and then there's also trust issues, potential for freezing or confiscation.
Yeah, I mean, like out of DC, whether it's Trump in the White House or Biden, I mean, there's threats of sanctions for Russia or other countries. So if you see that, and you saw what happened to Russia with their 300 billion of reserve assets, also I think there was 50 billion a year in interest payments, and that was also confiscated and used by DC however the heck they want. I think they gave it to NATO or they gave it to Ukraine. The money was spent on there to fight against Russia, so it was confiscated and used against them. I mean, if you're another country and you see that and you say like, well, we didn't mean to piss off DC and we did, and then they're going to confiscate it, it just makes more sense to diversify and stockpile what either gold tonnage. Central banks right now, Lynn, are not buying silver. So I guess it's too small. But we've seen China stockpile copper. They'll fill it up in a warehouse. And then we've seen some of these smaller emerging markets even start to say that they're going to start Bitcoin as a strategic reserve asset too.
Yeah. Yeah, I mean, we've already seen El Salvador, stacking Bitcoin. Kingdom of Bhutan, because they have a lot of spare hydro capacity, they mined quite a bit of Bitcoin. They're still mining it. So they got kind of rich on the sovereign level because they acquired a lot of Bitcoin. It's actually a really big percentage of their GDP now. Abu Dhabi has Bitcoin related assets in their funds, although ironically, some of those are custodial, like they'll buy a Bitcoin ETF, which is freezable, but they don't really see themselves on being maybe on the wrong side of Washington anytime soon. But yeah, I think over time we are seeing gold stacking. We're seeing Bitcoin stacking among maybe some of the smaller, more forward-thinking ones, at least in small amounts. Yeah, silver is a smaller market. It's also, much more volume to store for a similar amount of value. Um, but yeah, and around the margins, a little bit of diversification among currencies, but not too much. And we also see there's been an uptick in repatriation. So back in the 2010s, Germany repatriated some of their gold. It took years to do so, but they did it. And now there are recent headlines of Germany and Italy potentially, wanting to repatriate more of their gold. Because if you have gold in another country, that can be frozen as well. So, it only really gives you protection from that when you have it in your own borders.
Now, before we start talking about commodities, gold, maybe bottom up from some of these industries or sectors you think will do well over the next 6 to 12 months, maybe 18 months over this cycle. I want to ask you another macro question I haven't heard you ask before. Do you think that the U.S. and China are in a new Cold War and there's a huge technology arms race between the two countries, their militaries, and also their technology companies over what 5 or 6 key technologies: artificial intelligence, data centers, quantum computing, robotics, and drones?
Yeah, I do think we're in a Cold War. I would describe it as a softer Cold War than what the US and Soviet Union were in, especially around their peak. So it hasn't really reached that level yet. There's not really heightened risk of direct kinetic action on each other's mainland, for example. But there is, just a series of cyber warfare, economic warfare, trade warfare, battling over influence, which has a lot of Cold War comparisons. Um, we've starting with for example Trump's prior term and continued through the Biden administration as well. So that was something that was fairly consistent between them. They started sanctioning and pressuring China, tariffing China, and they've kind of focused on building more resilience in their own economy. Um, and so yeah, and then now they've, for example, during these negotiations, they've threatened rare earth access. And so I do think this is, I mean, this is by far the biggest kind of trade issue of our day. And China overall is a much more powerful economic contender to the United States than the Soviet Union was, in large part simply because of population. I mean, U.S. always had the population advantage over Soviet Union. And China, of course, has the population advantage over the United States. United States has other advantages. And China has exceeded the United States in terms of electricity production. They have a massive industrial base. They have very strong manufacturing capacity. Um, they have very strong logistics. Many of their technology sectors are getting very strong. They're now currently dominating vehicle exports globally. We don't really see it in the US because we basically block them. We're not the target market for it anyway, because right now they're particularly popular amongst less expensive and mid expensive cars around the world. But for example, you'll see them in BRICS countries, emerging markets, all over the place. So yeah, I would say the US and China are at least certainly in an economic war, and then that extends to multiple adjacent fronts.
And China, the citizens have a huge advantage in science, technology, engineering, and math. They're testing way above our levels for the average American. And our best and brightest that are best at STEM, they're normally coming from other countries to our universities. They're not domestically raised here in the United States. And I think even China in their government schools, like their K through 12, their elementary school programs, they're even requiring now artificial intelligence software be taught to the younger kids, so they're adapting to the technologies faster.
Yeah, and there's significant kind of network effects when a particular hub gets good at something. So like there's network effects of around finance in New York. There's network effects around startup funding in Silicon Valley, and parts of China have a very strong kind of manufacturing hub. So all the logistics and expertise of how to produce physical things, very strong kind of interconnections there. In addition to all the math and science and the other tech they're doing. Um, and they have a different, they're kind of like they often get described as top down, which is largely true. But there's different layers of how they do it, and they've struck like a what has so far been a pretty powerful mix, which is they'll make top down decisions of which industries should be given, more access to credit or not. And then, so that's top down central planning. But then at that lower level, the individual companies have quite a bit of competition between them to kind of sort out the best way of doing something. So, for example, top down, they'll say, okay, make credit way less available to real estate because we don't find that in our national interest anymore. It's a bubble. Instead, make credit available to the auto industry because we want to dominate car exports. And then after a few years of that, um, there's like a raging battle royale among car manufacturers who've been given credit, and a handful of them emerge toward the top. So
It's
you've got
deflation and creative destruction, and the car manufacturers, Lynn, are also making humanoid robots. So not only are they manufacturing electric vehicles that are better and cheaper, so there's beneficial deflation and creative destruction for the consumer, they're also learning with the manufacturing process, are also diversifying and building humanoid robots like Unitree,
yep, yeah, they
which I
are.
think is going to be the one of the next major industries over the next 5, 10, 15, 20 years are these robots.
Yeah, I think I tend to be a little bit bearish on the 5 year time horizon, but I think once you get a little bit further out, I do think that those will have pretty significant impact. I agree.
So right now, the U.S. officially doesn't have a recession. The stock market in the U.S. is soaring, maybe because of the liquidity that you mentioned, and there's a lot of foreign capital. I think foreign managed money is coming into the U.S. market chasing technology stocks. Do you think that we're going to see a lot of creative destruction as a lot of companies and other industries start to apply artificial intelligence software? Because I'm just seeing headlines where like law firms are looking at using artificial intelligence software that's customized from an open source like Llama from Meta, and they're going to turn it. It's going to do the artificial intelligence software custom program is going to do the work of a paralegal, or even like I think Microsoft was talking about like firing some of their sales staff and automating like salespeople online into like artificial intelligence bots. Do you think that that's going to potentially cause a recession over the next couple of years?
Depends how you measure it. It certainly, I think, is impacting the labor market and will continue to. Recessions have a number of other, measurement elements with them. There's this kind of like two-sided thing happening in the economy. So on one hand, the fact that we're running almost 7% of GDP fiscal deficits is stimulating. That's a more inflationary and stimulating type of uh, response. It's basically like, you're running recession level deficits before there's a recession, which in many ways makes it harder to have the type of recession that we normally have in a developed market. Um, but there are certain other industries that are very squeezed. I mean, the housing market's kind of shut corporate commercial real estate is obviously in peril. Um, any sort of like generally smaller businesses that are relying on shorter term debt instead of locking in like multi-decade bonds like big corporations can do. They've been pressured. So I think we have a very bifurcated economy. And for the AI component, there's a couple fronts where this is happening. I mean, the lowest hanging fruit, because AI does a lot of white collar work pretty effectively, and it's getting better every quarter, is you can just slow down hiring and get more out of your existing workers. So, one accountant with some AI accounting assistants can do a lot more accounting uh, than he or she could, maybe a couple years ago, especially as they get, used to using the technology and as technology kind of gets up to speed. And so, yeah, they can hire slower while doing similar output. In some cases, yeah, they can outright lay off, certain segments that are particularly heavily disrupted. Um, and it's a productivity boom, which is on the surface good for real GDP, even as it's put down pressure on employment. The other thing that it does, though, and this is we always focus on the negatives of what new technologies can do to labor, but it also potentially lowers the costs of certain goods and services. In this case, mostly services, and therefore makes them more affordable to people. And so there's kind of that yin and yang there. Um, but yeah, that's a pretty strong, I think, disinflationary force, particularly on the white collar kind of information worker segment. And I mean, I'm a general partner at a venture fund, Ego Death Capital. We're using AI to a considerable degree. We still hired a new analyst, but we are using considerable AI, and it boosts our output. And that's the case at companies, all around the world now.
There were some really interesting comments from the Goldman Sachs CEO. He said that basically, like to do an initial public offering prospectus, he used to take a team of lower level junior investment bankers, I think almost 8 weeks, and working around the clock, I think over 80-hour weeks. And he basically said that ChatGPT Pro now can do that much work of a team of the analysts. It can do it in a couple of hours.
Yeah, and I mean, it's so there's certain types of work that it's great at. There's other types of work that it still struggles with. I mean, I've seen AI try to build like financial models, and it'll be passed to me to look at, and I'll take one look at it and be like, well, it just doesn't make any sense, and here's three reasons. And so a lot of things still require human checks and human guidance. One of the recent kind of breakthroughs, I guess you can call it, in the past several months. Um, is more tailored type of work. And so, for example, let's say
Smaller
you're
models. Yeah, not full internet learning language model. Yeah, smaller ones.
yeah, and ones that are more specific. So, for example, like before, AI has been able to generate code for quite a while. But before it'd be like, hey, write me code for this function. And a more recent thing is you can say, like, let's say Bob Smith is the best at writing a certain type of program, APIs or whatever. And you say, well, write me an API for this using Bob Smith's open source code at like write it the way Bob Smith would, right? And so that's a more specific thing that it's able to do now. And so you can kind of assemble the best different subtypes from the best people around. And some programmers will do that for themselves. So let's say Bob Smith is the one um, making APIs. He's making these like let's say he's making interfaces, and he'll say, "Okay, study all of Bob Smith's open source code, and you're like my Bob Smith number two, and I want you to write this, this, and this." And so he's got his little army of Bob Smiths, or kind of each one might be 70% as good as Bob Smith. He checks their work, but that kind of more specificity is really important especially when you're doing something that requires quality and that you want something done a certain way. It basically gives the AI kind of more restrictions on how you want something done.
I think there's a lot of trial and error right now, but I think it's good overall. And I think the beneficiaries, the largest beneficiaries of this artificial intelligence software as it becomes better and cheaper, more productive, more efficient through the competition, is going to be businesses in other industries taking this software, say like the Google VEO3, which is the Google Video. I mean, I think a Chinese startup just came out and released a even cheaper version of it that's better on many metrics at a fraction of the price. So all this competition is going to be good for content creators, live streamers, and even like Hollywood companies making like or anime studios and stuff like that, as so they can get really high quality audio video at a fraction of the price that it used to.
I agree. Yeah, and I've actually used that example as well. That over time, because video is harder to generate than still images, but as it gets better, that'll be increasingly high fidelity. Yeah, it drastically lowers the cost of content creation, and then even like just routine back end stuff. I mean, if you're running a plumbing company, you've got back end like accounting and legal. You've got these kind of like white collar expenses that you're just paying in the back end. And now your accountant can, serve more companies than she could before, and your lawyer can serve more companies than he could before, because he has these AI tools kind of extending his reach. And so that can lower the cost and therefore boost productivity of the back end stuff that many people, don't want to think about and want to spend as little money as possible on, while still having quality.
Yeah, I was thinking about the Marvel superhero movies and how many years it normally takes for the CGI and how they have to outsource it for 100-hour weeks or more to these CGI houses, many millions of dollars. There's huge delays. You can tell that the video editing wasn't done by the same CGI house. But now with these artificial intelligence software programs, I mean, there's going to be enormous productivity boosts at a fraction of the price. They might be able to do 4K or 8K for a fraction of the price in a fraction of the time.
Yeah. Yeah, I think that's where everything's going, I think.
So as an investor, then do you think then that the data centers, the capital expenditure, the infrastructure required to build this out for the new technologies, is that where the majority of the profits are going to be made rather than the software innovations?
That tends to be how I view it. I think the software so far is demonstrating pretty low switching costs. Um, it's not clear that it's going to be super profitable. The reason, so during the 2010s, the rise of what is today like Mag 7, back then it was like Fang. Um, a lot of those things had network effects or high switching costs. And so they were able to have very, very high profit margins. This is a lot more, I mean, it's a lot more kind of hardware intensive, um, and
And energy. Yeah,
yeah,
yeah. So
energy
so you need the
intensive.
chips. So you need the chips, you need the data centers, you need the power, you need the infrastructure, you need all these things. I mean, look at the capital expenditure that big tech would. It's over $200 billion projected for 2025.
Yeah, and so I think that I'm less bullish on the software aspects because they have just so much physical capex they have to do. I think it's pretty good for the picks and shovels. That's not particularly a new take, but I think it's correct. And then the part that gets talked about less is that it's good for all the end users. It's good for all, like I mentioned before, a plumber that can save money on accounting and legal services now, and over the next several years, and all that stuff can just get way more efficient in the back end. Um, and I think that's going to be a boon for a lot of different industries.
Do you
And that's, yeah.
anticipate enormous increase in, say, a much higher plateau or floor in energy and electricity usage? Because not only are they building the Stargate AI facility in Texas, I mean, OpenAI Sam Altman, I mean, he's talking about building, I think they're building one in Abu Dhabi. Who's talking about building these facilities in a number of other countries? There was an announcement recently that Russia, because they have cheap natural gas, they want to start building giant data centers. So it seems like we're in a technology ramp up cycle, like a huge CapEx technology cycle now going forward.
So I think it'll be very big percentage growth in the AI space. It's starting from a very small percentage of electricity usage. And so it takes pretty enormous percentage gains to really kind of show up. It's kind of like how when you look at if you look at solar panel growth year over year, it's always like a really high percentage. But then when you zoom out and say, okay, what percentage of electricity is generated by solar? It's tiny. And so I think it's going to have that aspect for a while, where it's going to be building very rapidly from a small base. and take a number of years before it starts to become really, really meaningful. And yet it quickly becomes meaningful in those specific areas where it's being built out. And because unlike, for example, Bitcoin mining, which Bitcoin mining does not need to be near population centers, and it does not need high uptime. So they can go out to the middle of Kenya and do Bitcoin mining. They can do like programs that curtail energy, like they only kind of mine when there's an overabundance of energy because of, say, solar or wind, and then they can shut off whenever there's more expensive energy pricing. Um, the issue with AI is that people want high uptime with it, and they want low latency, so they want to be reasonably close to population centers, and so that does put pressure on, even as it remains for a while a pretty small percentage of overall electricity usage, uh, because that's a on the margins a new use case, and it has to be close to those population centers and pretty reliable. That I think that will be meaningful in those places.
It also needs more reliable electricity than Bitcoin mining because once those data centers are on, I mean, if the system breaks down, if people are online doing the research work or it's in the metaverse or something like that with artificial intelligence, because there's going to be all these different types of applications, you do not want the data center and the electricity, the power to go out. You need stable baseload electricity generation, say from nuclear power or natural gas. You need constant supply of energy. You do not want any systems failures. And then I think you want a across the board approach, Lynn. So you want solar panels or other types of energy at the data center too. You want like peak load added and then backups as well.
Yeah, that's what I meant by high uptime. So Bitcoin doesn't need high uptime. At least individual miners don't. And they also have lower capex costs. So Bitcoin miner has lower capex, higher opex. So they're more optimizing for cheap electricity overall. Whereas AI has higher capex and then higher uptime requirements, and they're less picky about electricity prices. Now it's still a variable, but they're less picky than Bitcoin miners, which is why they're able and kind of incentivized to go closer to population centers where they actually do compete with other businesses and residential for electricity, whereas Bitcoin miners basically wanted to go as far out as they could because they were after the cheapest, most stranded electricity out there.
Oh yeah, I think to add to your points there, I think the big technology companies, it was Microsoft or Amazon, whichever one was negotiating with Constellation Energy, I think for whatever they call 3 Mile Island now, I think they're willing to lock in long-term contracts at 80% above the spot price for guaranteed nuclear power. So if they're willing to do that and lock in a contract, I mean, the industry is going to love that because that's a higher profit and it's locking in a long-term contract.
Yep, absolutely.
So would you say then that there's a good case as long as this capital expenditure continues? Say, let's say the Stargate AI center gets finished, the Colossus data center goes from 200,000 GPUs up to 1 million in the next 6 years. There's additional Stargate facilities in other countries. Would you say that then this, as long as the capex gets spent and the data center gets built out, that we're looking at long-term bull markets for natural gas and nuclear power uranium?
I tend to think so. Yeah, I think those are but natural gas is cheaper, um, than many other sources of energy, and I think we're seeing the early signs of a nuclear renaissance. Yeah, I'm bullish on both of those. In addition, any sort of LNG terminal capacity expansion helps close the gap between inexpensive North American natural gas and more expensive natural gas elsewhere.
Yeah, we have Venture Global. They just got a permit approved, I think, in the last month. They're supposed to double their production, their LNG export facility is supposed to get larger than Cheniere Energy. So that one just went IPO, what, in the last 9 or 10 months?
Yeah, and the more that happens, the more that arbitrage can be closed because the main difference, you know this, but just for the listeners, oil, the transport cost is not that significant compared to the oil itself, whereas natural gas, the transport is much more complex. You generally, for longer distances, you need a pipeline or you need to freeze it. And so that's all more expensive and more limited and more time consuming to build. And so you can't geographically arbitrage natural gas as easily as you can oil until there's, a lot more LNG capacity online compared to overall usage. Because once that's all built out, you have a lot more capacity to arbitrage it. So you can, buy inexpensive North American gas and, say sell it wherever it's expensive, wherever there's a shortage. It could be Europe, could be Japan, could be elsewhere at a given moment.
I think there's a lot of profit potential for the pipeline companies to move the natural gas to data centers and to the liquefied natural gas export terminals, and also to ship the companies that are building the LNG export facilities, as long as they lock in a long-term contract to protect themselves when they're building out these facilities. The reason why you have this LNG market that you described is because a lot of these countries, especially in the European Union and elsewhere, they have oil and natural gas drilling bans domestically. So and they still need the energy. So their home domestic policies, what Spain is probably one of the best examples, because and also Germany. Spain had what, power outages, blackouts, brownouts for almost a week. I think part of France did too, but mostly Spain for a long time. They were heavily invested in solar and wind, and then they scrambled because those things were not working out so well. They didn't have reliable baseload electricity, and that hurts their consumer, it hurts their small business, it hurts their economy.
Yeah, I'm a pipeline bull, and I'm a bull on these energy dense base load types of power longer term.
So as we wrap up here, I have to ask you about gold stocks. So gold and gold stocks are the top performing, I think, sector in industry this year so far in 2025, or maybe over the last 9 or 10 months. Do you expect the industry to continue to generate free cash flow at high margins and potentially grow free cash flow?
So I think it will. I've been in recent months. I've been warning a little bit of a consolidation, just because gold was on a tear for a while. So even as a bull, sometimes you wanted to take a little bit of a break and consolidate, which can be healthy. Um, as long as gold is fairly expensive and oil is fairly contained, like it's not really breaking out or anything. That's pretty good for miners, because their revenues in gold and some of their expenses are, the energy costs. So that's pretty good. I trimmed a little bit into the strength, but not all the way. So I'm still kind of bullish on the broad complex. It's also nice to see platinum finally waking up. I've been a long-suffering platinum bull, so it's good to see that kind of showing signs of life for a change. So I still think that the general space has longer to go. And while I would fade, some near-term extremes at times, I still think that this cycle is has further to go.
Well, you also have copper around $5 a pound. So the copper price, if it doesn't crash, that's going to bring online in the not too distant future near term copper supply growth, and that will bring on additional gold and silver production. And then those royalty and streaming companies that you also, and I know you own companies like in the past at least, Franco Nevada, Wheaton Precious Metals, those guys are going to mint money if some of those other assets get built and they get royalty and streams, additional ones coming online.
Yeah, absolutely.
And that's how you have growth. So the people are saying like, "Oh, Wheaton Precious Metals is done." I mean, I've owned the stock for over 10 years. I think I bought it in 2011 or 12, around $15 a share, and I've just held it. It got up to 90 a couple days ago, and people are like, "Oh, you should sell it." And it's like it's a good business. They have additional growth lined up. I mean, they've been doing deals for years now, and now those mines are starting to get built, and those additional royalties and streams are going to come online. Why would I sell a growth business that could keep growing free cash flow and growing dividends?
Yeah, it makes sense to me, especially because, like you said, that's an area that you focus on pretty heavily. So people all have their kind of different areas of expertise. So they're able to kind of judge the industry better than others. I've been trimming a little bit into strength just because my attention is elsewhere as of late, rather than on kind of the precious metal sector. I've been preferring kind of the low IQ strategy of just owning a lot of gold. And other things around the margins, but mostly focusing on gold. So I do own silver, I do own platinum, I do have some of the mining and royalty companies, but I've mostly been expressing it just through gold itself, for that part of my portfolio.
Well, I was laying out the case that there's going to be future demand for additional silver, platinum, palladium, and gold. I think there, and even copper. I think we're going to need all these metals. We talked earlier about energy. So I think like any type of dip or crash in any of these key commodities, some other country, maybe it's because of the Cold War and the technology arms race, they're going to want to stockpile this stuff. I could start seeing that with rare earths too, in the not too distant future.
I agree. Yeah, I'm bullish on the whole complex, especially when you can find entities that are able to make good cash flows, with decent balance sheets at reasonable valuations. Because even then, when the underlying commodity is kind of chopped sideways for a period of time, you're still making money off of it, and then you have kind of an option that pays you to own it for whenever that might break out. And it might enter a shortage. A global economy might pick up. Potentially like a down cycle in the dollar, for example. So yeah, I'm kind of bullish on that whole space, and I try to be picky in terms of quality. But I'm a bull on the commodity sector.
Are there any other industries besides the gold stocks that are actually like growing their free cash flow right now, though?
Um, I actually the probably the most contrarian view I have is that I'm more bullish on financials than many others seem to be. Um, I think that both U.S. banks and to some extent emerging market banks are pretty attractive at the current time. And I think they've gotten past their worst period. I mean, they had the COVID lockdowns, um, then they had the stimulus, and then they had the hawkishness after the stimulus, which sunk some of the banks. A lot of them have been kind of preserving capital in recent years, and so there are multiple banks, both say in the U.S. In Latin America, that I've been fairly bullish on, and I think that they're inexpensive relative to their forward growth expectations, especially when you include the dividend. So we look at like a total return basis. I think the banks are going to be reasonably good, and you can kind of think of them in this context almost like pipeline businesses. Like you shouldn't expect much growth out of them, but when you look at them on a total return basis, and how underowned they are, um, I tend to find them pretty interesting.
Are those banks in the emerging markets, are their economies doing well? So like some of these emerging markets, are they actually not in a recession and they actually have loan growth? They're expanding profit margins. Are we seeing that?
It depends on the country you look at. I've been fairly bullish on Brazilian financials, for example. So if I look at ticker symbol ITUB, that's the ADR for Itaú Unibanco. That is currently at 5-year highs, more or less. For example, and it's been paying good dividends the whole time, and it's inexpensive. So sometimes it's not that a place is booming. It's that if something is priced to be dead and then you find out that it hasn't died and that it's kind of staggering along, uh, that usually is really good for the assets that have been sold for dead. So I've been somewhat of a contrarian on emerging markets as well as on just kind of financials in general, although I tend to be pretty picky because when you're entering some of these more risky spaces, you have to protect your downside.
I'll tell you what's contrarian right now is a lot of oil companies. So deep water oil companies, Canadian ones, Canadian oil and natural gas, they have a huge pipeline that's taking the oil from the landlocked area in Alberta, so Calgary and Edmonton area to the coastline, and they're opening up a liquefied natural gas export facility soon. So they have the pipelines that are going to move it there, and then the LNG export facility that could potentially turn cheap discounted oil and natural gas that was landlocked and selling at a discount into something that'll sell at a much higher price. So those companies have been cheap, but you're starting to see, I think, mergers and acquisition in the space now. Even Shell, what the rumors, according to Wall Street Journal, is looking at buying BP. So I was an oil analyst many years ago. I never thought I would see that happen. You're starting to see some companies that are normally pretty conservative with acquisitions look at buying cheap assets now.
Yeah, I think in many cases, because the valuations are not high across the board, in many cases, it's an easier decision to buy than to, expand yourself. Um, and so whether it's the oil producers, whether it's the pipelines, in some cases, kind of the oil field services companies, a lot of them are inexpensive. I don't necessarily see a great catalyst in the next few months for some of those, but longer term. I am bullish on the energy space.
Yeah, I agree. I think it's going to take a couple years, but if you're like an EOG Resources, you can wait 2 or 3 years for this to play out. So you don't have a lot
Yeah,
of debt on the balance sheet. You can go and buy the oil assets at a huge discount. You get the natural gas cash flows and lock that in at a profit, and you just wait it out as a contrarian over a couple years. So I think you're going to see that happen. But I think the Canadian there's some really like the discounts for deep water. I think Transocean, it was sub $3. It was a penny stock. I mean, like some of these ones, if there is a rally over the next couple of years, these things can make a lot of money.
I agree. Yeah, I'm bullish.
Well, I really enjoyed our discussion today. It's a very interesting time right now with all the craziness, all the cross currents with the macro stuff, because there's not an official recession despite all the craziness policies. Are you surprised we didn't have a lot of inflation despite the tariffs?
Not really, because one, it takes time to kick in, and two, we're not under a period of rapid money supply growth. And so when you do get price increases on certain areas in an environment where money supply growth is not happening too quickly, it tends to come out of somewhere else. Um, And so I think while certain categories will face stimulus, um, uh, I don't think it'll be enormous. And we look at the numbers. I mean, we see the May numbers for the deficit. We have the tariff numbers. I don't have them offhand, but it was something in the 20 plus billion mark for U.S. tariffs for that particular month. Um, that's not really massive on a nation of consumption. And so, while those are translating to higher prices in some categories, it's not a lot in the grand scheme of things of how much trillions are consumed per year. And so I think that while there's some inflationary pressures from those, that's not really, I think it's somewhat overstated. And I think there are other risks down the line for inflation. But yeah, that's I think the impact of the tariff is the bigger impact was more about freezing business decisions. There's multiple businesses that are like, we don't even know what tariffs are going to be in place in 3 months or 6 months or a year. So it freezes their ability to make decisions. I think that was a bigger impact than the price increases per se.
I mean, there is some price increases with food and other stuff, but yeah,
Yeah.
it's caused the distortions. I mean, I've seen some small business owners get hit with absolutely insane tariffs, but it looks like some of the larger companies, their profit margins are a little impaired, but it's the small business owner and the consumer that got hit the worst.
Yeah, because a lot of a lot of the big ones got exemptions. Um, and so kind of the worst case scenario is you do tariffs, then exempt the big ones, and then all the small ones get stuck with it. And then the consumers get stuck with it. Now, the magnitude is still, again, it's tens of billions per month, which is, in a, it's like, add a couple billions up and you're talking about real money. But in a nation of trillions of consumption, um, while it is something to monitor, it's not necessarily enormous, but it is impactful, and it's generally impactful toward, like you said, the weaker areas, the consumer, the smaller businesses. It's not impacting government. It's not impacting big businesses. It's impacting the ones that are less able to absorb it.
And I imagine the federal government loves those tax receipts coming in with the additional tariff increases because they didn't cut the tariffs, the tax receipts that were coming in under Trump's first term. So Biden didn't cut any of those because there was what tens of billions of dollars in tariff tax receipts coming in too.
Yeah, I mean they still their May they posted the third biggest deficit in May, with the only two worst deficit years in May being 2020 and 2021, so the massive COVID stimulus. And that was despite tariff revenue. So while they are getting some new tariff revenue, it's still dropping the bucket compared to the overall kind of deficit that they're running.
Well, DC, both political parties of Congress, Lynn, hate cutting spending. That's the
Yeah.
truth. The Republicans, they'll go on Fox News and they'll go in public, like the Mitch McConnell types, and they'll talk about free markets and small government, their policies, the stuff they voted for in Congress is the exact opposite. So anytime there's like a trying to balance the budget or something like that. I mean, they do deals for all these debt ceiling stuff. The debt ceiling, I was jokingly saying online on X that the debt ceiling stuff, everyone's like, why do they do the debt ceiling? It just goes up anyway. I was basically saying that both political parties in Congress and the White House, they just use the debt ceiling as a hostage negotiation.
That's why I say nothing stops this train.
It's a public hostage negotiation to get their pound of flesh and leverage, so everyone could trade their vote right for extra cash or favors or contracts for their district or corporate backers. So they can get a lobbying job later.
Yep.
Ah, that's a broken system, and you wrote a book about broken money because unfortunately, the system we have with the dollar as a world reserve currency, we're not going to see budget deficit cuts. We're not going to see a balanced budget. I mean, the math problem now, Lynn, with the interest payments on the debt, how quickly the national debt's growing, it's just a math problem at this point. I don't see the numbers slowing down.
Yep, me neither. I think for the next 5 years, 10 years, the deficit can be very big. That has investment implications. Generally speaking, it makes things run hot. Not necessarily all sectors, but in aggregate, it's a fairly kind of run it hot playbook. And so that's why I keep emphasizing. I think monitoring fiscal policy is very important in this era for investors.
And if I was a foreign central bank and I saw all this math and the budget deficits and how like, oh, we're going to pass a balanced budget or a Trump tax cut, and then the numbers, the CBO projects even larger amount of spending. I mean, there's no incentive for them to buy a lot more treasuries with the threat of debt monetization and financial repression and yield curve control coming in the near future. So that's why they're buying gold. That's why the central banker surveys in the World Gold Council, I think what 43% of the central bankers surveyed anonymously, they said they plan on adding a lot more gold over the next 12 months.
Yep, I'm not surprised.
Yeah, it just makes perfect math sense for them that like they're going to see the value of the bonds, their older treasure bonds are going to be devalued, so they're not going to want to take part in it.
Yep.
Well, please tell my listeners more about your book, Broken Money. It has excellent reviews on Amazon and what you cover in the book.
So yeah, check out Broken Money. It's basically the history of money through the lens of technology, so the past, present, and future of money. So if you want to, understand money at first principles, that's the book for you. And I wrote it in such a way that it appeals to a wide audience, but then also, for example, like institutional investors will give it to their friends. They'll give it to politicians. The I got a kick out of this. The governor of Ethiopia's central bank has it displayed pretty prominently in his office, or at least he did in this picture that came out. So that was like a lot of fun. So it kind of shows up in fun places. So it kind of has that aspect where it can appeal to kind of multiple different groups. So yeah, check it out.
Is the central banker of Ethiopia, do they have a strategic Bitcoin reserve, or do you think he's probably just with his own personal funds is buying precious metals and Bitcoin?
Yeah, it's hard to say. And he had other books that I would disagree with in the pictures. I think he's probably trying to collect books from a couple different perspectives. But yeah, someone pointed out to me that yeah, there were a bunch of pictures, and he's got this fairly small bookshelf with books of names you'd recognize, and Broken Money was right there among them. And I was like, oh, that's neat.
Well, I bring it up because over the years, I've interviewed a ton of hedge fund managers that people see on business TV and stuff. And in public on interviews, they might never say anything good about Bitcoin, gold, or silver. But I've spoken to them off the record, and they tell me, like, not for their client money that they're managing, but for their own personal funds, that they've been buying Bitcoin, gold, and silver for years. So, I mean, like, they were listening to the same stuff. They were reading your books. They were paying attention to the same stuff. And they were seeing that all these are bad policies, but their customer funds, they can't buy gold stocks or gold, silver, and Bitcoin, but they were with their own funds. So they were accumulating these things over the last 5 to 10 years.
Yeah, and that's when people say like government's going to do this or government's going to do that. I mean, it's important to remember that government is made up of people, and in many cases, the people in government, whether it's people in Congress, whether it's just random policymakers, a lot of them, like you said, a lot of them will own Bitcoin, a lot of them will own gold. They're like I know a vice president at a major U.S. company, like 100 billion plus market cap company. He's running his own Bitcoin Lightning node, so that's like really hardcore. Uh, it's just like there's people like that everywhere.
Was he
Um,
won't talk about it publicly, or is it like a secret or something?
yeah, I don't think he's been public about it, so it's not my place to talk about it. But yeah, you'll find vice presidents or board members or executives all throughout, the whether it's financial companies or energy companies or government, tech companies. Yeah, they listen to a lot of this, and just things move at a different speed at the organizational level than the individual level.
Yeah, I agree. I remember I was at the DC Blockchain Summit like in 2014, 15, 16, and there was vice presidents there from Microsoft and other companies, and they told me that while Microsoft officially didn't back Bitcoin, that they were buying a lot of it with their own funds. So I mean, the
Yeah,
people were paying attention. All the information is available online, and thank you for putting out great books like you do in your newsletters. You give away a lot for free.
I appreciate that. Well, thank you for having me on.